Hello, welcome back to the Rise and Fall Trading Hub. I'm here with part 11. This is now part 11 of 18. And thank you so much for those of you that have been with me from part 1. I hope you are learning a lot. Again, thank you for those that are giving feedback on how you are faring with your trading, especially using these strategies. Keep on giving the feedback. It really encourages me. So in this part we are going to continue, but we will be dealing with another candle pattern, not the engulfing patterns that we dealt with. I hope you are making profits using the engulfing patterns. Now today we are looking at another pattern. This one is called the first one is the dark cloud cover, a very profitable pattern, the dark cloud cover. Now the second one is called the piercing line pattern. So let's talk about the dark cloud cover first. Few points you need to note about this. Number one, the dark cloud cover, it may happen anywhere, but for you to be very profitable with it, make sure that it happens at the resistance area. In other words, after an uptrend. So there has to be an uptrend. Okay. Then after the uptrend, a green candlestick is formed, followed by a bearish one, a red one that starts above it. This is very important. So it has to be followed by a red one. The red one must start above the green one. So let's say, for instance, the green one closed here. The red one has to start above it, and it has to close past half of the real body of the green one. So if the green one, its half is that point. So look at this. The red one has to close past halfway through this green one. So there is an uptrend, a green candlestick is formed, followed by a red one. The red one has to start above the green one, and it has to close somewhere past half of the real body of the green one. So a good example is this one. Now, and remember, I'm saying it has to be on an uptrend. So look at this, a clear uptrend. I'm insisting on that. A clear uptrend. A good example of an uptrend is this one. So if this candlestick, it has started above the green one, but it has not closed past half. So the half of this candle is somewhere here. So if this red one closed somewhere here, this one would be a perfect example. So it has to be after an uptrend. So, but I'm just using this one for the purposes of showing you how these ones are formed. So there is a green candlestick, a red one starts above it, and it closes past half of the body of this one. So this one shows that the market is going to reverse. In other words, it's going to reverse and it becomes a downtrend. Okay. The dark cloud cover, uptrend, green candlestick form, followed by a red one. The red one starts above the green one. It closes past half of the green one. And of course, remember, if this red one closed somewhere here, that one will be bearish and curving. Of course, it would signify a downtrend also, but this one is now the dark cloud cover. Now let me first of all talk about the piercing line, and then I show you how to place trends and what to look at. So for the piercing line, it is the opposite of the dark cloud cover, so it has to form at the support area, in other words, after a downtrend. Then after a downtrend, what happens? A red candlestick is formed, okay, then followed by a green one that starts, a green one like that. So this has to be green. Nice. So this one is a downtrend. Then so this candlestick has closed here, right? The green one has started below it, and it has closed past half of the real body of the red one. So clearly you can see this is the opposite of the dark cloud cover. So how do you place your trend? Listen carefully. So immediately for the dark cloud cover, immediately the red candlestick closes, you are supposed to enter your trend immediately. Enter your trend immediately. But in the previous parts, we spoke about the retracement candlestick. I hope you remember that. And we said you really need to be careful when you are placing these trends, especially because of that retracement candlestick. Let me see whether, okay, yeah, I think I can use this one to demonstrate that. So this one is the piercing line pattern. So if you look at this pattern here, you realize that there is a downtrend. It's not a really good downtrend. Let me just use it to show you what I mean by the retracement candlestick. So after a downtrend, you can see there is a red candlestick followed by a green one, and if you look at the green one, it starts below the red one. I'm talking about this candlestick, this red candlestick. It starts below the red one and it closes past half of the red one. Let me remove this one. So if you are using the 5 minutes time frame, listen carefully, and the red candlestick has formed followed by a green one, in other words, the piercing line pattern has been formed. Immediately the green one closes, you are supposed to enter your trend immediately. But if you enter your trend using the 5 minutes time frame, in a situation like this one, you would make a loss. You would make a loss because of this candlestick. This is the candlestick we called the retracement candlestick. The retracement candlestick. It's normally a small candlestick, not necessarily a donji, but it's a red one instead of a green one in this case. So if you enter a trend using 5 minutes, you would make a loss. To avoid that, you do two things. Number one, if this one closes, the green one closes, you can enter a trend, but instead of using 5 minutes, you double this time frame and you enter your trend using 10 minutes. And the logic behind that is when the green one closes, the red one will take 5 minutes to form. So you have placed your trend but using 10 minutes. So the first 5 minutes will take care of the retracement candlestick, if any. The second one, of course, will be a green one, and that is where you will make your profit. So if you entered your trend at this point, your trend would end at this point, and so you would make a profit. Now remember, you can still cash out if you want. If the retracement candlestick was not formed, you can still cash out if you like. That's why I insisted on, first of all, we are using manual trending. Number 2, we are using higher time frames from 5 minutes onwards. From 5 minutes onwards. That doesn't mean you can't use 1 minute or 2 minutes. You can still use them. Only that when you use 1 minute, it limits your opportunity or your time for cashing out. So if you use 5 minutes, it will give you ample time to look at how the trend is, and you can cash out, especially if you are a beginner. You can cash out at any time. So use double the time frame. You can analyze using 5 minutes, 10 minutes, 30 minutes, or even 1 hour. You can analyze using higher time frames. Now, the second way of overcoming the retracement candlestick is by waiting for confirmation. In other words, after this green candlestick is formed, wait for the next candlestick to close. So if it is a red one, of course you won't enter that market, but you wait for it to close before you enter your trend. You can actually wait for the next one still to be formed, so that you are sure that the market has reversed. But the best from experience is doubling the time frame. So when the green one is formed, immediately it closes, enter your market using double the time frame, and even if the retracement candlestick is formed, it is well taken care of by the extra 5 minutes. That is the logic behind that. So that is generally how you place these trends. That is the dark cloud cover and the piercing line pattern. These patterns, I've realized that they are above 90% profitable. Above 90%. So I insist on doing a lot of practice with this. Make sure that the thing that I feel like insisting over and over again is when you are using either the engulfing pattern or the dark cloud cover, the piercing line pattern, make sure that there is a clear trend. See, for instance, there should be a clear trend. See, like this one, a clear trend, and then a red followed by a green that starts below and closes past half. That's when you enter your trend, but there has to be a clear trend. So avoid regions like these ones. See, even if it is formed somewhere here, try to avoid that. Let there be a clear trend. That way you are going to be profitable. So this is now part 11. In the next part I'll be talking about another pattern that is also very profitable. So thank you so much for watching. I hope you'll give feedback. In case you want to write to me concerning anything, or you want to write to ask a question or to request for bots, you can use the email in the description. Thank you so much for watching, and see you in the next one. And the next one will be very soon. I promise you that. See you.